let's read the following extracts from IAS 12 together. And I think these extracts are sort of the most relevant ones that we are going to need for the worked example. So let's just get a broad understanding of what the standard says in terms of deferred tax assets. Okay, so firstly, in paragraph 24, it says that a deferred tax asset shall be recognized for all deductible temporary differences, okay, to the extent that it is probable that taxable profit will be available against which the deductible temporary difference can be utilized, unless the deferred tax asset arises from the initial recognition of an asset or liability in a transaction that is not a business combination, and at the time of the transaction affects neither accounting profit nor tax profit. And this really is the paragraph 15 exemption. But remember, paragraph 15 is talking about taxable temporary differences. So paragraph 24 really relates to deductible temporary differences. And if you want an explanation on that, you can go back to my deferred tax video where I do a broad I do a summary of the deferred tax principles. I also have a video discussing the para 15 exemption in more detail, and I will link it above. Okay, so that's what paragraph 24 deals with, and it also says, however, for deductible temporary differences associated with investment in subsidiaries, branches and associates, interest in joint arrangements, a deferred tax asset shall be recognized in accordance with paragraph 44, but we're not going to look at that now because it's not relevant for our example. Paragraph 34 says that a deferred tax asset shall be recognized for the carry forward of unused tax losses and unused tax credit to the extent that it is probable that future taxable profit will be available against which the unused tax losses and unused tax credits can be utilized. And this really is the principle that we're trying to tackle in the example that we're going to look at, right? The idea is that if you have any unused tax losses, then you can recognize a deferred tax asset for those unused tax losses to the extent, okay, that it is probable that there is going to be future tax profit against which you can utilize that. Now, in paragraph 35, it says that the criteria for recognizing deferred tax from these carry forward unused tax losses are the same criteria for recognizing deferred tax assets from deductible temporary differences. So remember, if your deductible temporary differences are greater than your taxable temporary differences, again, you can recognize a deferred tax asset, and really these criteria are exactly the same. Okay, however, it says here, the existence of unused tax losses is strong evidence that future tax profit may not be available. So think about what that is saying, right? If you have an assessed loss, it might be a very strong indication that you will not have future tax profits. Now, of course, there are exceptions to this, because if you think about businesses that are just starting up, we expect those businesses as they're starting up to incur assessed losses because they have quite a lot of write-offs in their first couple of years, and their revenue, maybe they haven't expanded their market share or whatever the case may be. But the idea is that in the future there is going to be taxable profit. Okay, so when an entity has a history of recent tax losses, the entity recognizes a deferred tax asset arising from unused tax losses or tax credit only to the extent that they have sufficient taxable temporary differences, or there is convincing evidence, okay, that they have sufficient taxable profit in the future against which they can recognize it. Okay, in such circumstances, paragraph 82 requires the disclosure of the amount of deferred tax asset and the nature of the evidence supporting its recognition. So it's really saying that if you have a history of making assessed losses, right, and you still want to recognize this deferred tax asset, you've got to provide some convincing evidence, right, in order to do this. And if you've gone this route, you have to provide disclosure in terms of paragraph 82. So then in paragraph 36, an entity considers the following criteria in assessing the probability that the tax profit will that taxable profit will be available against which the unused tax losses or unused tax credits can be utilized. Okay, so the criteria are as follows. Okay, so you're going to look at whether there's sufficient taxable temporary differences relating to the same taxation authority or the same taxable entity, which will result in taxable amounts against which unused tax losses or unused tax credit can be utilized before they expire. So this is saying that if you have taxable temporary differences in the same entity with the same tax authority, right, then you can recognize an asset to that extent. And really, the taxable temporary differences are telling you that you're expecting to pay tax in the future. So if you have an expectation that you're going to pay tax, it really makes sense that you can offset your tax credits against that. Okay, also, we can recognize the asset, okay, when it is probable that the entity will have taxable profits before the unused tax losses or tax credits expire, when the unused tax losses result from identifiable causes which are unlikely to reoccur. So let's say, for example, the reason why we have an assessed loss is because there's this used write-off, right? That was kind of a once-off thing and we don't expect it to reoccur. Then we would still go and recognize it. And then the last criteria says when tax planning opportunities are available to the entity that will create taxable profit in a period which the unused tax losses and tax credits can be utilized. So if there are tax planning opportunities and you're able to utilize those assessed losses, then you can recognize a deferred tax asset. Okay, to the extent that it is not probable that taxable profit will be available against which the unused tax losses or unused tax credit can be utilized, you cannot recognize a deferred tax asset. So this really is the crux here. Okay, if you cannot demonstrate any of these criteria, then you are not allowed to recognize a deferred tax asset. Then it means that any deferred tax or potential deferred tax asset that you would have had, you can only recognize to the extent that you have taxable temporary differences. So let's go and look at a practical example to see how exactly this would work. So now we're going to look at a tax example, okay, where we're dealing with assessed losses. I'm just going to make up some numbers for a business, but for the purposes of this example, okay, we're going to say that the tax rate equals 28%, and let's say that the only thing they have that gives rise to depreciation would be a machine that they purchased at the beginning of the year for 100,000. They are depreciating over 5 years, and they can claim their tax allowances over 3 years. Okay, so let's say that is the information. Okay, so we're going to look at the financial year X1 and financial year X2. Okay, so for these financial years, let's imagine that the business has an accounting profit before depreciation of 15,000, okay, and 60,000 in the second year. And then every year we know that the depreciation is going to be 20,000 because it's being depreciated over 5 years. And we have our wear and tear, and our wear and tear allowances are over 3 years. So it's about 33,333 that we get to write off each year. Now, let's think about what the current tax calculations for this business would look like in years 1 and year 2. Okay, so let's start with our tax calc. So we're going to look at our current tax calc for X1. Okay, so we're starting off with our accounting profit before, okay, before our depreciation, and that is 15,000. Then we're going to take off our wear and tear, and our wear and tear is 33,333. So that brings us to 18,000, okay, 333. And over here we can see that we have an assessed loss. And an assessed loss, okay, basically means that we're not going to pay tax this year, but we are going to carry this assessed loss forward until we're in a position that we have taxable income, and then we're going to utilize the assessed loss against that taxable income. Okay, now that's year one. So let's look at the current tax calc, okay, for year two. And in year two, again, we're going to start with the accounting profit before depreciation, and that in year two is 60,000. Okay, then we're going to subtract our wear and tear, and our wear and tear in this case is 33,300. So that brings us to a taxable income, okay, or a tax profit of 26,667. Okay, so that is our taxable profit. Now, we're not going to calculate tax on that because we first need to consider the fact that we have a tax loss that is being carried forward. And from last year over here, okay, we can see that our tax loss is the 18,333. So we're going to bring that tax loss forward. Okay, and we're going to deduct it over there, and that is going to bring us, okay, to an amount of 8,334. So it is on that amount that we are going to calculate our tax. So our tax is at 28%. Okay, and that brings us to a final tax liability of 2,334. So this is the amount of current tax that we actually end up having to pay. Now that we've done the current tax, let's think about the deferred tax as it relates to this machine, right? So this is the only machine that is going to give rise to deferred tax in this business. So let's have a look at what the deferred tax looks like in X1 and in X2, just as it relates to the machine. Okay, so if we think about, okay, X1 and X2. Okay, so we have the carrying amount of the machine, and the carrying amount in X1 would be 80,000 because it's 100,000 that we bought it for, less the depreciation. And then at the end of the second year, it would be 60,000. And then our tax base, right? So our tax base is our future deductions. At the end of X1, it is 66667. And then at the end of X2, it would be 3334. Okay, so that's all of the remaining tax deductions at those points because we are claiming our wear and tear over 3 years. Okay, so then if we want to calculate our temporary differences here are going to be 13,333 in year one, and then 26,666 in year two. Okay, and these temporary differences, these are taxable temporary differences. Why? Because we're taking more of a deduction up front. So that means that in the future, okay, we are not going to have those tax deductions available because we've already taken it up front. So our tax profit is going to be higher than our accounting profit. So that means that our temporary differences today are taxable temporary differences. Okay, and as such, then if we use our tax rate, which is the 28% standard tax rate, okay, and we apply it to these temporary differences, then we get that the deferred tax related to these liabilities are going to be 3733 and 7466 respectively. So that is the deferred tax relating to this machine. Now we need to think about, well, what what impact does the assessed loss have on our deferred tax, right? Are we allowed to recognize an asset for the deferred tax? Now, the first thing, right, to consider, let's just do a little T account and let's see what our deferred tax looks like. And right now, I just want to isolate other temporary differences, okay? So we're going to do this T account over here with our deferred tax, and this is our other temporary differences. Okay, so at the beginning of X1, okay, our opening balance is null. Okay, then during the year, we would have had our deferred tax that went through P&L for the machine, and that is 3733. Okay, and then let's just do the closing balance over here. That brings us to a closing balance of 3733. Okay, we'll balance that. Okay, then in the following year, so in X2, we have an opening balance of 3733. Okay, we calculated our closing balance. Okay, we have calculated it up here. Where is it? Over there. Okay, to be 7466. Okay, so then our deferred tax that went through profit or loss was 3733,466. Okay, so at the end of year one, okay, what are we sitting with? We're sitting with other temporary differences, right? A closing balance, liability over here of 3733. And at the end of X2, we're sitting with a liability of 3766. Now we've got to think about, well, what do we do with this assessed loss? Okay, so there's really two scenarios we can think about with the assessed loss. Okay, and with the assessed loss, the first scenario is, well, let's imagine a circumstance where the business is not able to demonstrate, okay, that they will have future tax profits. Okay, so if they don't have any future tax profits, then that means that, okay, they are only allowed to recognize the deferred tax asset to the extent that they have taxable temporary differences. So if we look at a T account, right, for deferred tax, and this is dealing with our assessed loss. What does that T account look like? Now, at the beginning of X1, there is no opening balance. However, at the end of X2, right, we do have temporary differences sitting in our account over here. So we have a closing balance of 3733, right? Now, if we were to look at our assessed loss, I'm going to go up here again. Our assessed loss. So our assessed loss at the end of year one, right? If we multiply that by 28%, then it means that potentially we can recognize an asset of 5133. Okay, so I'm just going to highlight that over here so we can see that number. Okay, so 5133, that is potentially the deferred tax asset that we are able to recognize. However, if we are not able to demonstrate that there are going to be future tax profits, then we're limited to the temporary differences, the taxable temporary differences that we have, which means that we can only recognize a deferred tax asset up to 3733. Okay, so then during the current year, we will then have deferred tax, okay, for our assessed loss, which will go through profit or loss, and we're going to have 3733, okay, and that is 3733. So at X1, our closing balance over here is 3733. Okay, so the next year, at the beginning of X2, okay, we're going to bring down that balance, and that's the 3733. So that's our starting point, okay. However, what happens in X2? Okay, so in X2, we actually do have taxable profit. So that means that the that means that we have to now go and recognize previously unrecognized tax losses. So that means that if we take that 5,1, what was the liability? It was 5,133. Okay, so if we take the 5,133 less the 3,733, which we've already recognized, that means that there was 1,400 of tax losses that we did not recognize. So now, because we have tax profits, we go and recognize that. So that would be our deferred tax in P and L of 1,400. So now we recognize it. Then we know that the full assessed loss is being utilized in the current year. So again, we're going to have the utilization, which means we utilize up the full 5,133. And then if we just balance that account, 5,133, we can see that our closing balance at the end of X2 is 0. Okay, and that's exactly what we expect, because if we look at our tax calc up here, okay, we have actually fully utilized our assessed loss, so we don't expect a deferred tax asset to be recognized. Now, how would this differ if the entity is able to demonstrate that they will have future tax profits? So based on those criteria that we read earlier, how is our T account going to look different? Okay, so if we look again at our deferred tax, okay, assessed loss account. Okay, so again in X1, we're starting with an opening balance of 0. However, because the business is able to demonstrate that they are going to have future tax profits against which they will recognize the assessed loss, that means that they can recognize the full assessed loss of 5,133. So now our closing balance is 5,133. Let's just balance this account, and then it means that in X2 we have an opening balance of 5,133. Now in X2 we actually end up utilizing the full assessed loss, so therefore we have deferred tax, okay, our utilization, which is the 5,133, and that brings us to a let's just balance that, 5,133, 5,133. That gives us a closing balance of 0. Okay, so that's just to demonstrate that at the end of the year we now no longer have this assessed loss. So if we are not able to demonstrate, right, future tax profit, then it means that, okay, the assessed loss that we are able to recognize, okay, is going to be limited to any taxable temporary differences that we have recognized. Because if we have taxable temporary differences, it means that we expect to pay more tax, so we're going to recognize the assessed loss to that point. However, if we expect that or if we are able to demonstrate that there will be future tax profits, right, then we are able to fully recognize the assessed loss, and then when we utilize it, we would then de-recognize the assessed loss in the following year. I also forgot to touch on in this account, once you then utilize your assessed loss, you would have to go and recognize any assessed losses that you had previously not recognized.